Taxes. Oh my gosh. It's time to write that big check, isn't it, real estate investors? Hopefully you're doing well enough to have to be mad to write that big check. And today we're going to talk about last minute tax tips and then some other tips that on things that you should be doing all year long so that you're not so ticked off this time of year. So anyway, we're going to be back shortly. So go fill that coffee cup and get situated. We're going to have our buddy Bill Walston on here this morning to talk about how to save money on taxes. Share our YouTube link if you're on there. Let's get as many people on here as we can this morning. We have a good crowd today. We're going to give you a little freebie on saving money on taxes too. So anyway, we'll be back in 45 seconds. Good morning, sub-tours. Welcome to this edition of Goat Talk for March 31st, 22. Gosh, are we at the end of the first quarter? That flew by, didn't it? So we're going into the second quarter tomorrow. What are you going to do different to save money on taxes and buy more houses? We're coming to you today from Apollo Beach, beautiful Florida. We're down here for the next few months. Goat Talk is our weekly Facebook Live where we generally try to have somebody on here to help you with your real estate investing. Today we've got Bill Walston. He's going to come in here and tell you guys how to save a bunch of money on your taxes. If you're with us on Facebook, make sure you go to StreamYard.com/Facebook and give them the okay to know who you are, so we see your comments when you put them in the box there, and we can say good morning to you. If you're on YouTube, you haven't subscribed to us, please do. We've got a lot of videos that we put out every week, some things that are totally free to help you with your real estate investing. We'd love to have you join us. My producer's helping me out here this morning, so I don't have to try to do too many things at one time. If you're on here with us today, we would love to have your questions. Make sure if you've got any tax questions at all that you bring those things in here. We'll get those answered. Allie's here. She said she's never watched on YouTube. She's excited. We're excited to have you. Hey, Farouk, good to see you. Heather's here. Vincent's here. Good morning from Southern California. Woo. Gosh, I thought your gas was high a couple of months ago. It's about the same everywhere. Who knows? Tell us how much gas is in California right now, Vincent. Got Phil here this morning. Good morning. Good to see you. Okay, guys, we're not going to wait any longer. We got a lot to cover today. Remember, if you've got any questions, bring them. Good morning, Bill. How are you?
How you doing, William? Unfortunately, I am not coming to you from Apollo Beach, but what can I say?
Yeah, well, you're up there in the mountains, aren't you?
Yeah, but it's raining.
It's raining? Oh, yeah. It's a little cloudy here today, but you know the sun will be shining before long. Yep. It's never.
The fur kids are not happy. They can't go out. Yeah, they can't go out and play in the mud.
Oh no. Yeah, well, I think we're heading your way when we leave here. We're looking at North Carolina, Kentucky, or Tennessee.
Oh, sweet.
So yeah.
Yep, that's gonna be close.
We used to vacation in Highlands during the summer. Yep. So maybe thinking about something in that area. So we won't be too far away from you. So anyway, okay, let's see who else we got. Matt's here. Good morning to you. Kevin, good morning. Good to see you. Kevin's up there in Washington on patrol this morning, arresting all the bad guys. So good to see you. Hey guys, remember, please share our YouTube link. Let's see how many people we can get in here this morning. I want to give you that freebie. But in the meantime, Bill's got last minute tax tips, just some overall tax tips, and then we're going to take questions. So Bill, where do we get started this morning? What is the biggest thing these guys can do right now, before they have to file, if they've totally screwed up, what is the biggest thing they can do right now to try to fix something?
Well, right now, to fix something, you're kind of limited considering the day that it is, right? And some things you'd have to do, like purchases and stuff like that. So those are not last minute things you can do. Some of the things that you can do is fund a retirement plan, like IRA, 401k. If you have it, you have until the time that you actually file your return, including extensions. So extension is a beautiful thing. But you can go ahead and do that. A lot of people say, well, you can't do a retirement plan because the year is over. Depends on the type of retirement plan you want to use. You can do a SEP IRA, okay? Or you can do just a regular individual IRA and get up to like a $7,000 deduction for that. You can pay kids if you have them, allocate income to them. For stuff that they're doing at rental properties, or if they're helping you in your other business, they can make up to $12,550 and not have to pay taxes on it. And you get a deduction for that.
That has gone up a lot since I had kids. I could pay.
Oh, I know. And look at it this way. Let's say that you paid them $10,000. If you're in a 30% tax bracket, that saves you $3,000 in taxes right there. Right? And you would have to talk to your tax preparer. Some of them are more liberal than others are. I tend to be very aggressive. I'm looking at it, say, hey, did you pay your kids anything during the year? Did you buy them stuff? Did you give them gas money, put the gas in the car? Then you paid them. Count that, right? You don't have to give them cash now. You just have to be able to go back and show that you gave it to them. Some accountants will not do that. They say, hey, if you didn't pay them out in payroll and stuff, we're not going to count it. That's bull. Right. That's crazy.
Right.
Okay? You can still do it. Another thing you can do now, and I'll probably talk about this a little bit later. I always get questions about this: cost segregation on rental properties. Okay, if you have rental properties, you didn't have to buy that property this year to do cost segregation. If you didn't do cost segregation in the past, you can go back and file a 3115 form and catch up all that depreciation you missed out on. Okay, and people don't think that cost segregation is very helpful, right? I've heard somebody say, don't even bother with cost segregation. Single family house, it doesn't help you at all. I don't agree for this reason. I was working with a single family investor not too long ago. He got a property, $300,000. Let's say that it was give or take a little bit, but it was roughly $300,000, right? He wrote off $60,000 in 1 year, and that didn't even count the depreciation on the property itself. That was just in 179 and bonus depreciation on personal 5-year and 15-year property. And that's roughly, guys, what it runs out to be. The purchase price of the property, roughly about 20%, you can usually attribute to 5 and 7-year property and write it all off. That's going away pretty soon. Okay, so if you're not doing it now, right now we got 100%. 2023, that bonus depreciation drops down to 80%. Now, 80% is still better than nothing, but it's not like being able to write off 100% of it. So those are some things that you can really do right now that would benefit you greatly in your tax, especially the cost seg for us real estate investors on the rental properties and stuff.
Hey, JC, good to see you this morning. He says, good morning, guys. We got Sarah Shepard in here from Memphis. Good to see her. And got Cindy Crane down in Mississippi.
Hey, Cindy.
Yeah. I knew Cindy wouldn't miss this. She loves for both of us to be on here together. She says that she doesn't need an interpreter when it's up. She knows what we're talking about. That's
we
right.
can just let your producer interpret for everybody who doesn't understand us this morning.
That's correct. Hey, you got Marcia in here. Good morning. Good to see you guys. If y'all have tax questions, make sure you let us have those. So let's see. What are some other things that you see most investors just overlooking, especially new guys? Some of these people in here, we got some real pros, but some of you newer people, there's a lot of things you don't know about.
Well, yeah, and here's something that is very basic, right? And people say, well, that doesn't have anything to do with taxes, but it really does, and that's record keeping. Okay. That is one of the biggest problems that I see a lot of investors have. And guys, you got to treat your business like a business. You don't want to be scrambling at the end of the year trying to come up with all these deductions, because you're not going to be able to wait till then and remember what you paid out for things. You need to do your record keeping during the year, right? So that's really, really important that you do that. And it's also important if you ever get audited. Okay. If you get audited, heaven forbid, right? You don't want that. But if you do, did you know that auditors tend to look more favorably on taxpayers who have records kept, good records that they can go back and refer to, right? And if they check that out and they say, oh yeah, this guy's documenting stuff, right? They don't tend to question your deductions quite as much and don't go into quite as much detail. They expect that.
Yeah. You know, I had a conversation actually yesterday with Randy. He's one of our Mac students in Arkansas. And this guy's a machine. I mean, he buys 15 houses a month or so. He's always been a lot like me, the one-man operation, you know, responsible for everything. And we were having that conversation yesterday about things like record keeping and taxes, and about how entrepreneurs, doers, tend to really put that stuff off because it's not a money-making function at all. And it's just not the exciting part of the business. And he said, you know, I've been doing this now for 10 years and I'm at this place. I'm just having to hire this stuff out because I don't want to do it anymore. I'm not very good at it. I don't keep up with it. And that's, you know, learn that now, even if you're new. If you don't want to do these things, a bookkeeper's not that expensive.
No. Really not. And generally, when we're first getting started, we don't have that many transactions to do anyway, right? So if you got somebody coming in and doing it for you, it works really well. But that's where we fall. I mean, you know, I harp and tell my clients all the time, focus on revenue generating activities, right? Well, bookkeeping is not one of those. So like everything else, we do tend to put it off, but there's some things that you can only put off for so long. It's like bill paying. Right? That's not a revenue generating activity, but if you don't do it, the light's going to get turned out. Okay. If you don't keep up with your record keeping, guys, you're losing valuable tax deductions because you don't think about it. You know, people come to me when I was preparing tax returns, and even now as tax strategists, they try to wait until the end of the year, and I'm asking questions, and they say, "Yeah, I don't remember." You know, oh yeah, I think I can find that receipt. You got to keep up with the records, right? And the next thing is do advanced tax planning. Don't wait until the year is over, you know, to kind of look at what we're talking about today, which is last minute tax deductions, right? Do tax planning. You should not be waiting until year end, like April or January, February, March, and that be the first time that you talk to your tax accountant or whoever's preparing your tax return or whoever's helping you with your tax strategy. That's not the time to do it. You need to be talking to them during the year. Yeah. Right. And you need somebody that you can trust to do that.
Hey, Bill, we're getting a couple of questions. Good morning, Carlos. Good to see you. Ron Hugall, good to see you here. Gabby, good to see you. Hopefully Raphael's on here as well. Carlos has a question, and his question is, what about investing through an IUL? Someone selling IUL approached me.
Okay. If it's what I think it is, IUL, I don't keep up with all these acronyms. I'm sure it has something to do with universal life. Okay. I don't.
Yeah, I think that's what it is.
Recommend that. I can't remember if it's index universal life or something similar to that. But I think it's that where people are talking about, oh yeah, let's do infinite banking and things of that nature. I'm not saying it doesn't have its place. Okay, but it's at the end of the food chain. There are other things that you ought to be doing before you try to start using that. So I'm not a big fan.
Okay. Just maybe. Hey, Joni. Joni's in here. Hey, Joni, good to see you. Joni's down here in Florida. We're going to have to catch up with her sometime.
Joni was playing in the Caymans not too long ago. Yeah, I know what that gal's got going on.
She's a player. I know she gets around. So. Vincent said, is it true writing off your home office is a red flag for audit?
Absolutely not. Okay. It is not a red flag for an audit. Honestly, I tell people, say, you know what? IRS would be allowing the deduction if it wasn't valid, right? Now, I think sometimes the way you report it might have something to do with whether you're being audited or not. But if you're doing it correctly, it's not going to raise any red flags, and you're losing a lot of valuable deductions if you don't take it. I know some accountants don't like it. Right? Too bad. So sad.
Well, you need a different accountant.
That's right.
You really do, and I learned this very early. You need one with the same tolerance for risk that you have.
Absolutely. And you think about it sometimes, and you look at how often has your tax preparer called you up on the phone and said, "Hey, guess what? I got an idea to save you some money."
Yeah, not very.
Not very many. Right?
One that specializes in dealing with investors. You're not going to have somebody from H&R Block call you up with that sort of thing, or probably your local generic tax person's not going to.
No, most of them don't, because they're historians. By the time they get your information, everything's happened. Okay. I always tell people, say, please, people that I work with, my clients, I say, call me before you do something major. Okay. I was talking to a gal this morning. Okay. And she was switching jobs. Okay. She is a real estate investor, but she's a nurse, and she was switching jobs. And she had an opportunity to roll over her retirement. Okay. Roughly $300,000, $400,000. Right. So the money gets rolled over. She called the people up, and the guy didn't have time to talk with her right then. Okay. He'd get back to her. All right. Now, she's a little firecracker, kind of like we are, and they didn't get back to her soon enough. And then when they finally did get back to her, he was rude. Okay. So she says, "Send me my money. Okay. I'm not dealing with you. Send me my money." And he said, "Okay." And she said, "Well, what's going to happen?" He said, "Well, you're going to have to pay tax on it." And she said, "How much?" And he said, "About $40,000. And she said, "Send it to IRS and send me the rest." Okay. What he did not tell her, and what she did not consult with her tax accountant, is that was just a penalty on an IRA distribution, or a retirement distribution, right? That was just a penalty. He did not tell her that $400,000 was going to be added to her taxable income for the whole year, right? And she was going to end up owing $120,000 in taxes.
Wow.
By the time we chatted, it was too late, man. Too late to do anything about it. You should always, and I mean, that's an extreme circumstance, right? I was talking to a real estate investor the other day. Fortunately, we chatted before he made a decision, and he's using a 1031 exchange on a property. Guys, 1031 exchanges are great, and you need to take advantage of those. Somebody says, "Well, Bill, 1031 exchange, what difference is that going to make for me?" Right? I'm just, this is a single family property. Why should I do a 1031 exchange? Well, look at it this way. If you sell a single family residence, let's say you made $75,000 gain. Is that unusual these days to sell a property and have a $75,000 capital gain on it? Properties appreciate, man. That's an average gain now. Did you know on a $75,000 gain, if you do a 1031 exchange, you save about $18,000 in taxes? That's worth doing a 1031 exchange, guys.
For sure.
Talk to your tax people before you do something, right? At least bring them on board and let them know what you plan on doing. But I digress. You can see I get on a rant sometimes.
Well, Bill, I know you do consultations and help people with planning, even for their, so they can inform. And I'm speaking out of turn here, but I'm guessing you would do three-way calls with investors and their tax people.
If necessary, we will do that. Yeah, I do a lot of tax strategy. I don't put anything on tax returns anymore, and so people sometimes think that, well, what's the big deal? Why don't I just go to my tax guy? Number one, he probably doesn't know what we know, right? Because he hasn't been around. He's not a real estate investor. So when I'm working with my folks, we do what we call get them tax ready. Right. We do the strategies, we help them make the moves, and then we help them get their stuff ready to hand it over to their accountant so that it's ready. And all the guy has to do is what he normally does anyway, and take the numbers that you give him and put them on the tax return, right? It's just that we massage those numbers and get them ready before you meet with your guy.
Okay. Sarah said, who has a good bookkeeper they will share? So if anybody out here has a good bookkeeper, you guys give us a name so Sarah can.
And guys, remember that your bookkeeper does not have to be in your area.
Mm-hmm.
Okay. Most bookkeepers can work virtually now. So if you can find a good one, use them.
Mm-hmm.
Okay. Use them.
Right. Okay, guys, if I get 10 of y'all to tell me that y'all have shared our YouTube link, I'm going to give y'all that tax guide that we talked about this morning. So if 10 of you will share our link on your Facebook wall in a group that won't get you kicked out, we'll give y'all that today. We got another 40 minutes before we have to do that.
Give us questions.
Matt asked, do the taxes look any differently on wraps than say a fix and flip or wholesale?
It depends. Okay. That's always a good answer, right? It depends. It depends on what you're doing with the wrap. If you're taking a property and you're holding it like as a rental, or if you are doing owner finance on it, something like that, the taxes are totally different than if you are just flipping the property or wholesaling the property. Flipping a property, wholesaling the property is what we call a dealer transaction. Okay. Dealer transactions are god awful. You don't want to have dealer transactions if you can help it, because they are subject to self-employment tax. They're considered active income, and you pay right off the top 15.3% plus any ordinary income taxes on that money. Okay. It's wholesalers and flippers are not real estate investors. And some people may want to drop a safe on my head for saying that, but it's the truth. Okay. You're not an investor. You are actively in the real estate business, right? But it's a trade or business. And I know those are tax terms, but what IRS considers a trade or business, they tax completely differently than they do investment incomes. And your investment income is either passive income or portfolio income, which is like your rents and that type of thing. Okay? Even some short-term rentals are going to be considered active investments. So you have to be careful with those.
Okay. Tammy says, glad to be here. So am I, Tammy. How does that say? I bet you've heard this one too. We were talking about sayings this morning about finer than frog hair.
Finer than frog hair.
I'm just like the mole on Marilyn Monroe's face. I'm just glad to be here. That one, let's see.
I've not heard that one in a long time.
Yeah, well, I'm old. Let's see. Heather said she burned a property 2021, started renting it in February 22. The repairs went under a C Corp, and I personally loaned the money to the Corp.
Okay. And I guess, what is the question?
I guess her question maybe, was that the best move? How would you have done that, Bill? How would you have
well, first, the repairs would not have gone under a C Corp, because I don't ever hold property in a C Corp.
Yeah.
Never, ever.
Can't get them out. Yeah.
And because, I take that back. This may be a special circumstance. Okay. And with the way the property is set up that way. But ordinarily, okay, a C Corp is my last resort of doing with properties. And I know there is a so-called group out there who shall remain nameless, but they're suggesting that everybody ought to do their wholesaling in a C Corp. Okay. What they don't tell you, it's nigh on to impossible to get the damn money out once it's in a C Corp, because the only ways you can do it is either through a W-2 salary or a dividend, which is taxable, okay, or to dissolve the corporation or get it back. I'm sorry, the third way is to get it out as reimbursement of some type of an expense.
Well,
okay?
Maybe
you don't have the flexibility.
Some follow-up stuff here. Do I state on Form 1120 the C Corp owes money or has a zero return for 2021?
Well, a C Corp may have a zero return, but you still got to file it.
She says
Okay.
an LLC is managing the rental now. Should this continue under the C Corp, or is it correct I moved it to an LLC?
LLC is managing the rental. All right, so there's a rental. So we got a rental property, and a C Corp is involved somehow or another. Okay.
Okay.
So I'd have to. I'd really need to go in and get more detail.
Okay.
Ask about how it's being held.
Let's invite Heather in here.
Yeah.
And Heather, I'm just going to post the link here.
We're gonna put Heather on the spot.
We're gonna put the link out here. So I think I shared that. So but hopefully we won't get any crazies in here. There's the link, Heather. Come in here and explain what's going on with that, and we'll get you a straight answer. In the meantime, Andrew has a question.
Okay.
Good morning. How much scrutiny will paying my kiddos $12,000 a year warrant from the tax man? I do have them do things, but record keeping is not too hot.
It depends on the age of the kiddos, but here's the thing. If you are employing your own child, you don't have to do any withholding tax. You don't have to file a W-2 form. You don't have to file a 1099 form. You just take the expense on your tax return. And if you're ever audited, you need to be able to substantiate what you paid them. So you should keep records. There should be a timesheet or something like that telling what the kid has done. But you just throw it in with your other expenses like contract labor or whatever they're doing. If they're cleaning the office, it's cleaning expense, those types of things. So there's almost no scrutiny.
Yeah. Okay.
If you report it correctly.
Okay. Come back, Heather. We saw you pop in here. We just didn't have a chance to bring you on. So come on back, and we'll get you in here. In the meantime, we'll take Tim's question. Tim said, "I currently live in a triplex. Can I write off a new roof?"
You live in a triplex. Are you writing? Are you renting out the other parts of it?
I think he is.
Okay. So if he is, right, then he can write off 2/3 of a new roof. Okay. Now it has to be done in a specific way. Okay. But yeah, 2/3 of that can be depreciated.
Okay.
And if you claim it as a roof repair instead of a roof replacement, you can probably write off more of it.
Okay. Jen and Brad shared the link. Thanks. Appreciate that. Okay. Vincent did as well. Okay. Here's Heather. So we're going to find out all about her burr thing that she's got going on. Good morning, Heather.
Good morning.
Okay. So tell Bill all about your deal.
Tell me what's going on, Heather.
So I bought the property in my own name. It's not in the C Corp.
Gotcha. Good.
I was running, I've just done all the bookkeeping.
Okay.
And put it all together, have all the expenses. But yeah, I wasn't sure how to allocate everything because I have an LLC and I have a C Corp. And pretty much I just haven't said anything because it just started. So I started the C Corp in July.
Okay.
And yeah. Did that help?
Okay. That does help. All right. So how is the rental property held right now?
It's still in my name. I haven't changed it over to a trust.
Okay. And are you planning on doing that? Because if it stays in your name, right, then it's going to be reported on a Schedule E for the rental property. All right. So tell me a little bit about the expenses that you said you ran through the C Corp.
I guess that's the part that I haven't really done technically because I had the bank account and gave money in that and then bought the house.
Okay.
But I didn't put any names under anything.
Okay.
And then I was just thinking, and I've kept it in my name because I just refinanced out of that. And so now that's where I'm going to switch it and just get it all straight.
Well, unfortunately, you don't have to move a property out of a C Corp, which can cause all kinds of tax problems because it would be treated as a dividend and the transfer out would have been taxed.
Okay,
Since it's still in your name, that's fine.
But do you want to know the expenses like repairing it?
Sure, if you want to throw that in.
Yeah.
So have you put the property for rent yet?
Yeah. Mm-hmm.
Okay. Was it in rent when you were doing the repairs, or did you have to do the repairs first?
I did the repairs first.
Okay. A lot of those repairs and stuff are not going to be treated as expense write-offs for that year. Some of them are going to have to be added to the cost of the property.
Okay.
That said, do cost segregation on the property itself. Okay, so that's where you're going to be able to get some write-off. Okay, so you're going to want to take a look at the property and you're going to say, okay, how much of this is actually building? How much of it might be appliances, right? Because appliances are write-off. That's not part of your building. You can depreciate those appliances over 5 years. And since we got 179 and bonus depreciation right now, whatever the cost of those appliances might be, you can write off 100% of that in the year you put the property in use and start renting it.
So that's 2022.
That's 2022?
Got it.
Okay. All right. So what I would say just in general is none of the expenses that you did in 2021, not going to be able to write any of that off, okay, because the property was not ready to be rented yet. So you actually have a property that goes into service in 2022, and you're going to be able to do a cost segregation and write off the bulk of those costs, but they can't be in 2022. You can't put them on like a profit and loss and say, I paid this much for this repair and this much for this repair. Now, anything going forward in 2022 that you're doing, you can write that off as an expense item.
Okay.
And in fact, you want to. You don't want to have renovations and stuff like that after you put the property in service, because all you're doing is adding to the basis of the property. You're not getting any repair or write-off benefit. You want to be able to write them off as expenses, as repair expenses, instead of being part of the cost of the property.
Okay, gotcha. So if you're repairing your property, that's the cost of your property. But if you're
rehabbing and getting it ready for use, it's part of the cost of the property. Okay,
that makes sense.
But let's say that you buy a new appliance, okay, or you fix up an appliance, maybe not buying, but let's say you're painting as part of the rehab, that expense has to be added into the cost of the property, believe it or not. If you're painting in between rentals or something, that's an expense. And there's a difference in the way it's handled on your tax return.
Okay, gotcha.
Does that help?
Yeah, that does. So my C Corp, technically, like I should just do a 0 return, and it didn't really do anything, did it?
No, it didn't.
Okay.
And so my question would be, since it didn't do anything at all, is are you going to use it going forward?
Yeah, that's a good question.
And if you're not, I would do a 0 return, but I'd mark it final return and get rid of the sucker.
Oh,
unless
really?
you can think of some reason to maintain it.
Okay.
Yeah. Or you could actually mark it final return. And then you could keep it like what they call a shelf corporation. You can keep it active, but it's not doing anything. It's not doing any business or anything until you can find out what you want to do with it.
Okay. Yeah, my idea was to flip houses, and that would be the expense in it.
Yeah, I would think that there's other ways to flip houses.
Okay.
And here is why. I was getting to the point about how to get the money out, right? Let's say you have your C Corp buy a property, and you flip that property within the C Corp. Okay. And you end up with a profit of $15,000. So you got $15,000 cash in the bank, $15,000 profit showing on the tax return. Okay. At the going rate right now, you would owe 21%, or the corporation would owe 21% taxes on that $15,000. But that $15,000 is just sitting there. Okay. Heather can't do anything with it because it doesn't belong to Heather. It belongs to the C Corp.
Oh.
Okay. So the only way Heather is going to get that money out of the C Corp is to take a salary. And guess what happens if you take a salary?
You pay tax.
You report that $15,000 on your tax return, and you pay taxes on it. Well, damn, the corporation's already paid 21% taxes, and now you got to pay taxes on it again. That's the old thing about double taxation. Okay, with the C Corp. All right. The other way that you could get the money out is for the C Corp to declare a dividend. All right. If the C Corp declares a dividend, then it gets taxed as a dividend when you take it. So either way, you're going to pay taxes on that money. Now, I'm not saying that there aren't some ways that you can get the money out kind of like without paying tax on it, expense reimbursement and stuff like that. But in order to do that, you've got to justify expenses and things that you have done on behalf of the corporation to be reimbursed for. And you can do planning and do that. I'm just giving in general. Those two things are reasons why I do not like to see properties in a C corporation. Then let's say that you put the property in there and you say, oh no, now I want it to be a rental. Okay, well, if you want it to be a rental, the C corp has to still treat it as a rental, and then they get the advantages of all those rental expenses, right? The depreciation, everything else. Because if you transfer the property out of the C corp into your name, that's treated like a dividend. It's a distribution. So C corps just, I think, are messy. Until you start making as in South, we used to say a sheet load of money. Okay, you don't want that properties in a C corp.
Okay, cool. Thank you.
You're welcome.
Thanks for joining us, Heather.
Yeah, let's see. I'll go ahead and leave though.
All right, we'll talk
She
to
doesn't
you
want to be under the spotlight any more than she has to. I see how that is.
later. All right, let's see. Tammy's got a comment here. She said, I invited everyone in my Facebook group to watch. Good stuff. Thanks, William and Bill. Hey, thank you, Tammy. Appreciate that. Vincent asks, is it best to flip properties under a C corp?
Well, Vincent, I would think not.
Yeah.
Because of some of the same things that I just said. Not because it's not feasible, okay, but because it's very difficult to get the money out if you need it for anything. Right now, if you're going to maybe fund a 401k plan for you, right, and you take the profits and you run them maybe through a 401k plan or something like that, then maybe there are places that a C corp can be useful. Okay, I think that's kind of like advanced planning, and that's when you might be full-time in the business and you're flipping full-time. Maybe that might be a time to be using a C corp. Any other time, I would not. What I would basically try to do is say, hey, I don't flip that many properties, and I really bought this property with the intention to hold it as a rental, and I just got an offer that was too good to turn down, and that converts that from a flip sometimes into what we call a sale of investment property for capital. Okay, and you can report it as a short-term gain and pay just ordinary income taxes on a capital gain instead of self-employment taxes on a flip income or flip profit.
Right. Okay. Andrew, bingo, bango. Bill is the man. I agree. Bill's great. Let's see. Matt says, what does taxes look like on an owner finance? Is there a way to lower them? Do you get a larger tax on the down payment collected?
Okay. Taxes on an owner finance depends on how you structure that owner finance and what type of property it is. Let's say that it is classified as a rental property and you sell it on a contract for deed or anything where you're carrying paper back. Okay. For tax purposes, that can be treated as an installment sale. That allows you to calculate the capital gain that you receive and pay the taxes over the life of the loan. So in the first year, okay, the only thing that would be taxed was a down payment. Okay, you would have to report all the down payment is for tax purposes. Okay, and then any of the capital gain that you are extending out, you would recognize only a portion of that. There is not a larger tax on the down payment. Tax rate is going to be the same, but you just happen to get more cash that first year. Okay, so you would pay more taxes on the sale that year, but not a larger tax rate.
Right. And don't let your accountant tell you that because you're selling a house that way, you have to classify it differently.
That's right. All right. So, William, that's a very good point because what some accountants will try to do is say, "Oh, you bought that profit to do a quick turn on it," and they try to classify it as a dealer transaction, and they say, "Oh, this was inventory." Mm-hmm. Okay, and the bad thing about them doing that is you don't get to take advantage of the installment sale. Right. You can still sell on an installment sale, and you take like 30 years to collect your money, but all the taxes are due in that first year. So you're paying what we like to say is you're paying taxes on phantom income. You're paying taxes on money you didn't even get yet. Right. So you have to report 100% of the sale as tax, okay? But you don't collect your money until the next 30 years.
And that's a big thing investors have this issue with, is this dealer status.
Well, most accountants, if they don't know what's going on,
Right.
they will treat it as a dealer transaction.
So
see, they don't know the difference in selling an investment property and a rental property. Okay.
Mm-hmm.
Most of them don't have a problem putting rental properties in the right place. Okay. Schedule E, that's where they put them. They put them in the right place. They usually report that correctly. Where they have difficulty is the sale of a property. Now, if it's a sale of a property that you've been renting out for 10 years, they can handle that. They know it's not a dealer transaction. But if it's something that you've held short term, right, maybe not the whole year, then they try to throw it into a dealer transaction and throw it onto a Schedule C every time.
Mm-hmm.
And that's not where it goes.
What they're doing, I mean, they're costing you a lot of money,
Yeah.
as far as taxes, paying the taxes on that phantom income.
Well, just all right. So let's look at it as $100,000. Let's say that was the profit on it, $100,000. By misclassifying it that way, they cost you $15,000 on self-employment tax, and then another 20% in just regular income tax. So you're looking at $20,000 plus the 15. You're looking about $35,000 in taxes that you pay on that.
Do a dozen of those houses a year and do a quick calculation. Okay.
Yep.
But you determine. I mean, listen, I don't know about you, but I tend to be. I change my mind a lot. Pretty much every house I buy with the intention of keeping it as a rental. Y'all know I love rentals.
That's right. All the time.
Somehow, some way, before it gets into the rental category, I change my mind and decide to sell it. That's just the way
and here's the thing. You made a very important point, intent. What do you intend? Right? Now, you do have to be reasonable with your intention. It can't be every property that you buy, okay? But it can be a few of them a year if you need to, right? And who's to say that if you buy something that you're going to owner finance, my owner finance properties never get treated as a flip for this reason. A lot of times I'll start off with a lease option. Okay, what is a lease option, right? You start with the lease option, put them in as a rental. 3 months later, I may switch it over to a contract for deed. That property is still an investment property, even though I only rented it out for 3 months. Doesn't matter. You still showed, and that's documented intent, right? So that's why some of us do the things we do with getting in with lease options and then converting to contracts for deed. Other things that you can do is in your LLC, in your minutes, when you sell a property quickly, you can say the members decided on such and such a date to sell XYZ property for capital to be used in additional investments. That's one of the exclusions that IRS has for you to be able to sell a property quickly and it not be classified as dealer transaction. That's an exclusion of dealer transactions. Just some of this stuff, folks.
And if you think, well, the IRS isn't stupid, whatever, if you get audited, okay, that's the first if you get audited.
Mine is if they are stupid, but that's
right.
Okay.
And then I know of cases where people have been audited that almost exclusively sell with seller financing. And even on numerous transactions that year, only had a couple of them changed to a dealer transaction. The rest of them they totally ignored. Why? Yep. Well, I don't know. And it doesn't
could be
matter.
documentation. Could have been the documentation. Yeah.
If you're willing to roll the dice,
and
that's the worst thing that can happen. You have to pay tax later.
Yeah, and that's an important thing too, guys, is everything is moot unless you get audited. Right? So that's one of the first things that you try to do is audit proof your tax return. Right. And one of those ways is try not to have anything reported on a Schedule C and try not to have anything reported on a Schedule E, because that's on your personal return. And those are two of the most highly audited forms on your personal returns.
Okay. There you go. let's see what we got here next. Well, I don't know what's going on here. This thing isn't cooperating with me. Tammy says, thank you, Bill, for all your help this past weekend. So did you help Tammy move or something?
Tammy had a tax question.
Yeah. Well, there you go. All right. Okay. Jeff shared the link. We appreciate that. Could I get a short 5th grade description of cost segregation?
Absolutely. Cost segregation is when you look at the purchase price of your property and you realize that all of that's not building, right? Included with that purchase are appliances, flooring, cabinets, the shrubs in the front yard, the sidewalk in the front yard, okay? Landscaping. Trying to think some others. That's just an example, all right? So what you're essentially doing is saying, okay, I'm going to allocate this much of the cost to the property or to the building itself, the structure, okay? But I'm going to allocate this much of the cost to appliances. I'm going to allocate this much of the cost to landscaping, or what we call land improvements. Okay, so you're going in and you're segregating the cost out into 3 different types or 3 classifications of properties. Building, which is depreciated over 27 and a half years, land improvement type things that are depreciated over 15, and then personal property type thing. And believe it or not, personal property is your appliances and things like that within the house. Okay, that's 5-year property. But right now we have a situation where that 15-year property, that 5-year property, whatever cost you allocate to those classifications, you can take 100% write-off for it in the first year. That's huge. And that's where I was getting to. It runs roughly about 20% of the purchase price. And then whatever your tax rate is, okay, or I'm sorry, not even the tax rate, because you're writing off 100% of it. So that's where I was saying, if you bought a $300,000 property, then you would probably have about a $60,000 write-off when you allocated about 20% of those costs to either 15-year or 5-year property.
Yeah.
And that might still be confusing. I hope that was a 5th grade description. I'm not sure.
Mm-hmm. It's really just a way to have a much bigger write-off that first year.
Right.
When you buy that property, instead of, again, over the 27 and a half years, you can take a significant portion of it and take that write-off right now.
Right. And guys, I will tell you, everybody says, oh yeah, I can't do a cost segregation because you got to hire an engineer to do it and blah, blah, blah. Well, you do if you're buying a multi-million-dollar apartment complex. Okay. Not if you're buying a single family home. There are guidelines, IRS guidelines, that will let you know about what you can expect and about what you write off, which is why I feel very comfortable saying about 20% of the property. I have those guidelines. Your accountant should be able to get those guidelines very easily as well and step you through cost segregation. And guys, I will tell you, if you ask your accountant, say, hey, look, can I do cost segregation on my property? And he says, get another accountant. Okay, get another accountant. I had a client this year who said, oh, my accountant said I can't do cost segregation because it's a single family house. Okay, not true.
That's your first sign.
That's the first thing. But see, this is the same accountant that also told him that he could not depreciate a property because the loan was not in his name. Okay. Well,
this person had a sign way back then.
Yeah, apparently.
Yeah, that's not the right guy for you. We talk about this all the time, whether it's a realtor, whether it's a closing attorney, an insurance company, find your person, and your person knows that whose name the loan is in. Doesn't make any difference on whether or not you can have ownership of that property.
Right. Also doesn't make any difference of whether you can take the mortgage interest deduction or not.
Right.
If you're making the payment, you can take the deduction. I don't know how many times I see people asking, well, I did a sub-2 property. Can I take the loan deduction? And I'm thinking, why are you even asking? Because their accountant told them they couldn't.
Oh, wow. Okay. Carlos asked, what if you lend the money? I'm guessing that's lend the money from the C Corp to the LLC.
Meaning as a way to get the money out of a C Corp?
Okay, let's give us a little bit more
I
context.
think that's what he's talking about. Remember we were talking about Heather's C Corp? And and I was saying that you would not be able to get the money out. That would be a problem. So could you get it out with a loan? Sure you could, and you might get away with that for a year, okay? But eventually somebody's going to say, why aren't you paying that loan back? Okay, and you say, oh well, I'm gonna write it off. Well, when that happens, the C Corp, you have income because the C Corp is taking a deduction for writing a bad debt.
Okay.
So I would not recommend that strategy. Can you get away with it for a short period of time? Sure you can. I just think it's better not to use the damn C Corporation to begin with.
Just leave them alone. Stay away from the C Corp.
Yeah.
Okay. Guys, we got about 10 more minutes if you've got any last minute questions. Kevin asked if Bill, if your consulting is on an hourly rate, why don't you just give Bill a call or
Kevin,
send
him shoot me a message on Facebook. Okay. Yeah. It's not, by the way, I don't believe in hourly rates, but hey, people get shocked when I talk about my hourly rate until I show them I can save them about 5 times in taxes what we talk about.
Marcia asks, can you do a 179 write-off 4 years after for impact windows?
Can you do a 170? Marcia, you can do cost segregation anytime. Okay. It does not have to be in the year that the property was purchased. So can you? You absolutely can. Would it be worth it? Maybe. Okay. It depends on the situation, but can you? Sure you can. You can go back and do that. Somebody says, well, what if it was like 6 years ago? Doesn't matter. You can still go back and do that. Accountants have what's called a Form 3115, which allows you to go back and figure the depreciation expense you did not get to take and the write-offs you did not get to take. And you calculate them and you come up with the dollar difference, like what should it have been and what's the total amount I missed out. And they will let you take all that missed depreciation and write-off in one tax year. Okay, so it's like, okay, my depreciation was wrong for the last 5 years. What do I do about it? You adjust in 1 year. You don't have to go back and amend tax returns. People think that you do. You do not have to go back and amend the tax return. What you do need to do, and you'll hear me talk a lot about, is cost-benefit analysis. Okay, is it worth going back and actually doing that? And I would venture sometimes it will be. Okay. Because an accountant's going to charge you to do 3115. And you talk about 3115 to some accountants, and they're going to look at you like, okay, who have you been talking to? Because that's not a common form. It's a change in accounting method, and most accountants don't know how to use them.
Which brings us to Matt's question. How do we hire a good tax person like yourself? It is expensive. Matt, if you've been listening to us, you've heard several examples today about how having the wrong accountant is very expensive.
It's more expensive to have the wrong one than it is to get
one example of, let's go back to the $300,000 house where your accountant tells you you can't do cost segregation because it's a single family, right?
And you would have written off $60,000 in the first year. Okay, a direct write-off. Now, that just decreases your taxable income by $60,000. So it wasn't a tax savings of $60,000. It was only a tax savings about probably about 15, 20,000, depending on your tax bracket. But I don't know with any accountant that would have charged you $15,000 to do a cost segregation.
But here's the other thing. I'm telling you, and this is without fail, and this is everybody that you deal with on your team, again, whether it's a real estate agent, an insurance company, a closing company, whatever it may be, if they don't know that, there's 1,000 other things they don't know.
Oh, yeah.
And everyone, that's why I said earlier about that example, this was the same person that told her she couldn't do this and she couldn't write off interest on a loan in someone else's name. If they don't know one key piece, they probably don't know a bunch of other ones, and it's all costing you money, every bit of it. You need to have knowledgeable people that work for you.
I will tell you that a good tax person will save you far more than what it costs you.
Yeah.
Okay. And as expensive, I know people talk about it, how much is the dollar amount? It depends on accountants. Some accountants set their rates much like attorneys do on some things. Some charge by the hour, some charge by the project, some do retainer work. So it just depends.
Okay. Matt had another question. Do you recommend any books or places we can learn more about tax dues and donuts in real estate?
Any good books? There's a book by Amanda Hahn, and you can find it on Bigger Pockets, okay, or on Amazon. On Amazon, just Google real estate taxes, okay, or real estate income tax, and there's a lot of them. I recommend hers as one because she's an investor, and there's two of them. There's one that's just regular tax info, and then there's one for advanced strategies, right? And her stuff is pretty good. The problem with that, though, is the implementation part. You can read all about it, right? But unless you go in and implement what it is and find somebody who will help you implement it correctly, right, then it's not worth the purchase price. But if you don't have someone who acts as your tax strategy, that type of book will give you some good topics to talk to your accountant about, okay? Then the only thing is your accountant going to know how to answer the question? Or is he going to be one of those that says, oh, well, yeah, I heard that works, but I really don't think it does, and just kind of like move on.
Okay. I have found it to be nearly impossible to find a tax strategist. It definitely hasn't been the last 3 or 4 CPAs I've used. I think, and we don't know who you are because you're on Facebook. We go to StreamYard.com/Facebook, and we'll be able to see your smiling face and know your name. I find the two to be separate: a tax strategist,
yeah,
and then someone to do either someone very knowledgeable to do your accounting, or someone that follows direction from your tax strategist, right, and just does what they're told. Which, right, I like people that do what they're told.
There are a lot of tax people out there, but he kind of summed it up. It's nearly impossible to find a tax strategist. That's because there are not many of them out there that really understand tax strategy from a real estate investing standpoint, right? So one of the first things you might ask your tax strategist is, hey, do you do tax returns for other real estate investors? And 2, are you a real estate investor yourself? Okay, those are 2 important things that you'd want to kind of find out.
Right.
But shoot me a text. I can put you in touch with some people who I do know a few who are both preparers and strategists. Okay, I'm not a preparer. I'm happy to tell you that. Okay, I am a strategist, not a preparer.
Okay. Bill, let's let everybody know how to contact you. I believe I've got this right. If I can, didn't do it there. It's Bill at BillWalston.com. Am I right?
Yes, that is correct. Okay. Or on Facebook.
Yep. Or on Facebook.
Oh yeah, I'm easy to find on Facebook. You can shoot me a private message on Facebook.
Tag, if you're in the Sub2 forum, tag Bill in the Sub2 forum, and he'll come answer your question. And
yep, a lot of times people don't ask tax questions in those forums. I find that some of them aren't afraid to. Others don't realize that tax questions are related to subject to deals, so they don't ask their question there. If you got a question, ask it. If I think I need more clarification, like we did with Heather this morning, I might shoot you a private message and say, "Explain, please."
Yeah. For sure. Tammy made a comment. Reach out to other investors in your area, see who they recommend and use for advanced tax strategies. It's CPA as an investor as well as a bonus. Vincent said, unfortunately, I signed up with Anderson Advisors.
Vincent, now I know why you are thinking about using a C corporation for wholesaling.
Vincent, you need to just contact Bill.
I know why you're using a C corporation because Anderson is the group that is really talking about that and pushing the C Corp strategist. Yeah. Also, what's entirely interesting, and you take from it what you will, Anderson is also the group that says, hey, pay us this amount of money and we'll do unlimited LLCs and C corps for you.
Yeah. Okay. Well, enough about Anderson. Guys, contact Bill. Just send him an email, bill@billwalston.com. Tag him in the forum if you're in the forum. Contact him on Facebook. He's easy to find. Knock on his door. He's up in the mountains somewhere.
That's right. If you can find me, come on by.
Yeah. I appreciate you guys that shared this. If you'll go to sub2deals.com/tax tips, okay, you can get this report we've put together, 11 great tax tips for real estate investors. And it's absolutely free. So just go there and get that. And we appreciate y'all. Hey, Bill, thanks for being here today, sharing tax tips. As
always a pleasure.
We appreciate you. Guys, we're going to let you go. We'll catch you next week. So get out there and buy some houses. We'll see y'all next time.